this webinar after the event, and we will kick off. So just a little bit about Central FX before we start. So the company was established in 2010. So we're in our 11th year. We're still privately owned. We are authorized by the Financial Conduct Authority under the Payment Services Regulation of 2017. And that's absolutely critical for what we do, as a lot of you will understand. And we're also registered for money laundering regulations and money services businesses with HMRC. To date, we've instructed well over 150,000 individual payments, totaling over £5 billion. That's since our inception. So we've helped a lot of clients over the years, both private and corporate, in the B2B sector across Europe and across North America. We operate safeguarded accounts with Barclays Bank PLC. So at all times, client money is completely segregated from that of Central FX and completely safeguarded and ring fenced. And just to give you an example of some of the clients that we work with currently, they range from obviously high street names, as you can see there, right down to a management consultancy in the form of Deloitte. You might not have heard of us on the high street. We don't have a high street presence. We're not a retail bank. We are a telephone-based foreign exchange broker. So that's probably why you haven't heard of us to date. So getting on to today, what we're going to show you. We're going to illustrate to you how to manage an FX exposure without uncertainty. And I think that's going to be key. Obviously, there's a great deal of uncertainty currently in the world, particularly with the pandemic and off the back of Brexit. And our experience shows us that a lot of financial directors that we work with, it's more the uncertainty and the lack of visibility that cause them sleepless nights, as opposed to whether they're going to get the best price at the moment in time that they transact. We're also going to show you how to produce and formalize a company hedging policy. A lot of our clients know what they're doing, know what they would like to do, but that's not written down anywhere. They can't refer to that at a management executive level. And we found that having an actual hedging policy in place not only protects the individual, but gives the company a clear line of sight, what to do next and what to do in any further uncertain times. We're going to show you, as I said at the beginning, in a light form, a currency risk audit. This is where we analyze a company's information, financials, cash flows, costed price, payment details, payment terms, and create an audit that's based on that information. And we're going to illustrate to you the power of doing that prior to entering into a hedging policy or a hedging strategy. And as we say with the top of our webinar today, we're going to look to show you how that there comes together and eliminates the volatility of the foreign exchange markets. And then towards the end of the presentation, we're going to show you how we stress test, based on various scenarios, the impact that currency fluctuation can have on company profitability. And I think, again, a vital point, particularly with the pandemic, particularly what's happening in the world, the ability to stress test a scenario. What would this mean to our company? What would this mean to our bottom line profitability? How would this affect us? Having that information to hand is absolutely vital currently. So let's get on to the problem. The challenges that we're going to look to address is extreme and unexpected market movement. I think we can all agree, over the last 12 months particularly, we saw a 15% move in the foreign exchange markets in February, March of last year. We've seen extreme volatility on the announcement of Brexit, when it will be, what it will entail. No real-time information. Having information as it happens that can enable you to make the right decisions is also critical. And having no visibility. What is it that I need? What is it that I've got? How is my company currently positioned with its current requirements and its future requirements? And based on what is happening in the world today, what would that mean in 3 months' time? And we've got here no decision-making protocol. What we've found when we've talked to clients is that often if the market rallies or goes to a significant level, decisions will be made in an instant. There'll be snapshot decisions based on where the currency is right now. We see a sudden market movement up and another executive in the company will make a decision based on that movement. but it's outside of the protocols that were not formally decided, but might have been informally chatted through at the last meeting. So the ability to have a hedging policy document that very clearly stipulates what we're prepared to do in each example, in each scenario, gives a financial director and his team or her team a great deal more peace of mind. And we're going to focus a little bit on opinion-based decisions. Currently, you might be working with a bank who is giving you their opinion on when to buy foreign exchange, but the very definition of opinion is that it can only be right 50% of the time. And we choose to amalgamate opinion with data. So that the data that surrounds your business, that's absolutely fundamental to its success or failure, is also brought into the decision-making protocol. And all of this, as we know, is created by political climate and unforeseen events, and particularly Brexit. One of the reasons that we now manage our clients' foreign exchange exposures in this manner was born out of the Brexit scenario. I think if we cast our minds back 4 or 5 years to the day of the Brexit vote, 10 to 10 the night before, when the exit polls were showing us that potentially the people who were undecided were going to vote stay. And I think if you can remember, the sterling dollar rate was at 155. And it was a shock, to say the least, at 6:30 when everyone woke up. I mean, we obviously saw it happen all night and play out in front of our eyes. But when most people woke up early that morning, we'd left the EU and sterling dollar was down at 136 and only going lower. What that meant to the financial directors of this world was not so much what should I do, but what have we got? There was no immediate visibility. There was no policy in place to say, if this scenario occurs, this is what we will do. And so the ability to have that understanding instantaneously, as opposed to having to wait until the relevant person arrived in the office and fired up the Excel spreadsheet that only they had on their computer, and at that point we could then have the discussion, we choose to give people that information at the beginning, before the problem occurs. It's much like putting a fence at the top of the hill rather than an ambulance at the bottom. Let's protect ourselves before the situation arises. And I just want to show you a graph of sterling dollar over the last. We're going to focus on sterling dollar today to keep it relatively transparent and easy to follow. But you can see from this graph, we've seen extreme volatility. I mean, you look in March there, the middle of March, that's lockdown. 132 to 115, pretty much overnight. What did that mean to your business? How did it affect you? What did you do about it, most importantly? What could you do about it? And obviously we've seen it move back up to the levels that we've got to today, but I'm sure during that period of time, there's been an awful lot of uncertainty and an awful lot of indecision. What should I do? Is it going to carry on? Is it going to drop off? But by having a hedging policy that is based around your data, based around the information that you put into your currency risk audit, those decisions are taken away from you. The indecision is taken away from you. And you can follow that plan. And if you follow that plan, the market movement is not going to affect it on a daily basis. And I just want to show you a little piece of information we put together where effectively a 5% move in the foreign exchange markets can wipe out 52% of a company's profits. If they're working on a 10% profit margin, and this is what we have seen in the course of January 2021, we've seen a high of 138.15 and a low of 131.20, a differential of 5.08%. Now, if you're working to a 10% profit margin, that movement alone can wipe out 50% of your profits. And very often when we talk to people, they have a great deal of confidence in the market at that moment in time. And we can't predict the future, nor do we pretend to do so. But if you can stress test a scenario, you can say, well, what would happen if the market moved 5%? What does that mean in pounds and pence to my company? And ultimately, what does it mean to the future stability of my company? Then you put yourself in a much stronger position because you can make decisions based on that. And you couple that up with the information that we then provide our clients and the opinion-based service that comes together with the data and with the hedging policy, you have a much stronger position with which to set yourselves going forward so that this scenario doesn't happen to you at any point. So what we're going to do now is actually look at how we do this, what a currency audit entails, And we're going to look over the course of the next 12 months and see what that might bring. And towards the end of that, we're going to show you how we stress test this and how we can create a scenario where you can see what might happen and what that will actually mean to your business in pounds and pence, so that you can make decisions today based on it. So at this point, I'm going to hand over to my colleague, Gary Hassel, our Chief Operations Officer, who is going to take you through a currency audit and illustrate to you how we get to the position where you have a hedging policy strategy document that you can now make quantifiable decisions on that make tangible differences to your business. Gary, over to you. I might need to unmute you. Let me just unmute you. There we go.
Beautiful. Thanks, Simon. Can I just check sound check? You can hear me okay?
Yes, I can, yeah.
Perfect. Thank you very much. Thanks, Simon. So Simon has, in the previous slides, identified that clearly there is a big risk due to currency fluctuations. So you're aware of the risk and you start to think, well, I want to look to do something about it. 52% of my profit margin potentially going out the window is not something that we can leave on the table. And so we want to start to do something about it. Before we do that, before we think about a prudent approach to managing that currency risk, let's look at some common mistakes that companies unfortunately find themselves making. So improper implementation of currency hedging strategies. So you set out with good intentions, you set out to try and limit your or reduce your currency risk, but you, by unwittingly making some mistakes, you actually increase your exposure. So if we've got any sales directors or anything like that on the call, please close your ears for a moment. Let's take an example where a sales director is going into a new market and they have quite bullish forecasts for what they think they're going to sell in that new market. And then the financial controller or financial director, based on the sales director's forecasts, goes into the market and buys some currency based on those numbers. And let's say that the sales director was overzealous in his forecasts, and whatever transpires, he falls and the company falls way short of their sales forecast. And what happens is the company is now left with that currency that the financial director or controller purchased as a direct result of those numbers. And what they've done is they've now got an amount of currency that they probably need to sell back to the market. And so they have increased their risk. So that's one example of an improper implementation of a strategy. Another thing to think about is only managing certain currency exposures. So one of the golden rules that we and our clients successfully live by is if you can quantify the risk, then you should look to mitigate it no matter the size. So an example may be, if we cast our minds back to January 2015, Swiss franc unpegged itself to the euro. And what happened is, in an instant, there was a 30% Swiss franc euro movement, and there was a 25% Swiss franc US dollar movement, similar movement with sterling. And that movement, although instant, once that had settled, there was a readjustment, and though that exchange rate was 13% different. So the next day was 13% different than the day before, and 12% on dollar. So if a company thinks, oh, in that example, I had a relatively small exposure in Swiss francs, so I'm not going to manage it like some of my bigger exposures. If the exposure is small, but the movement is large, then the impact can be as acutely felt as some of your larger currency exposures. Hedging for the short term and praying for the long term. A really clear example of that would be only hedging or focusing on invoices or sales orders once they've been raised. So 30, 60, 90-day terms that you have either with your clients or you have with your suppliers. So what about the rest of the year and beyond? If you want any form of pricing consistency or profit consistency, you need to be looking at a bigger time period than those 30, 60, 90 days, because clearly currency is going to continue to move outside of those periods. And finally, limiting currency hedging only to the current budget cycle. So you're doing well. You've identified the three previous mistakes that people can find themselves falling into. What happens is companies will often only buy currency or hedge for a budgetary year or a calendar year. So let's say a company in January buys in the form of forward contracts their requirement for the next 12 months, and they have their final currency purchase value dated in and around December of that year. So what happens is November, December time comes around and the financial director or controller starts thinking, okay, I need to start thinking about currency purchase for the next year. So if the exchange rates have moved 5, 10, 15%, which isn't out of the realms of possibility, what happens is when you next go to the market to buy currency, you are either buying your currency at an extreme premium or an extreme discount. So if you want to have any form of price consistency or profit consistency, you need to be looking outside of your simple budgetary cycle or a calendar year. And the ways that you try to avoid those mistakes is focusing on these four key factors, which is your timing, clearly the amounts, the cash flow, and your ability to forecast. And as we go into the next slide, please, Simon, as we go into what the currency risk audit is, this is where it starts. This is the first port of call when we are establishing the most prudent approach for an individual company to take. And is the main focus of today. So you need to start to be able to quantify the risk if you wish to manage it. So we'll enable the company to make decisions based on actual data rather than anyone's opinion. So it starts with the audit. Then we're going to stress test to highlight and sometimes more importantly visualize the potential impact certain scenarios would have on the company profitability. And then we'll start to determine how much risk the company is prepared to leave on the table. And then start to think about that as an important number and an important figure that the company can start to work towards those parameters. A pounds and pence number that the company is happy to leave with regards to risk to foreign exchange. You then produce a policy. So once you decide what you want to do or how much you want to protect or leave on the table, you should put that down in a policy. It gives justification for every decision that is made with regards to whether you buy currency or whether you don't buy currency. And it also gives the individuals within the company that's the person that is actually executing the transactions, it gives them protection over their actions and decisions. And so to reduce the risk of foreign exchange, one of the things that you need to do is have that policy. Clearly, you need to implement that policy, and that's the next point. But one of the things that we often, Simon and I have the pleasure of reading company accounts on a fairly regular basis. One of the common statements that you hear in company accounts is words to the effect of, to reduce the foreign exchange risk, the company buys currency in accordance with company policy. It's in countless financials, countless accounts. And actually, if you dig into that, there generally isn't a policy. And so the question is, do you actually have a policy? And if you don't, that's something that you should be looking to consider. And then you've got to implement the policy. It's no good having a policy if it just lives in the bottom drawer. And the implementation of that policy, there are numerous considerations, more than we're going to have time to cover today. And so it's at that stage that you would engage with an executive currency strategist at Central Effects to help the implementation of that policy. And so we're going to start to have a look at what a currency risk audit looks like, and we'll show you that in the system. So Simon, I think you've just given me control. Thank you very much. Let me just bring this up. Okay, so what we're going to go through here is the data points. So starting to assess your risk, and to do that we need to factor in and get a number of these data points answered. I'm going to focus on a couple of the core ones and then scan over some of the other questions just based on time constraints for today. This is a real example of a company that we helped. Give you 30 seconds background. They're a healthcare company, and pretty much overnight, their two biggest customers turned around and said, I want to start paying you in dollars. And so they needed to have a way and a mechanism of managing that, because their biggest customers are now paying them in non-pounds. So when they approached us, they weren't currently hedging their currency risks. Based in the UK, no subsidiaries, and I would classify them based on the way that their currency works as an exporter in the healthcare section. Company's primary reporting currency is pounds. If we have anybody in today that has any experience or works in the oil and gas or raw materials, often those companies' primary reporting currency is dollars, and so it's just something to be aware of. But this company, UK based, they report in pounds, and their exposure is in US dollars. So what we start to do is we start to build up a cash flow forecast. So when the company approached us, they didn't have any budget. They didn't have a budget rate for their US dollars, and they have income in dollars. So from their two main clients, they were receiving about $600,000 on a monthly basis. I'm going to touch on seasonality shortly, but for intents and purposes of this point, let's assume that they're going to be receiving a flat amount of dollars on a monthly basis. And one of the most important questions, and to spend a moment on that now, is how often they update their pricing with regards to foreign exchange rate movement. So they set their pricing, this company set their pricing once a year. They publish a catalogue of sorts, and they fix their pricing to their customers on an annual basis, which means that if the exchange rates move within that 12-month period, there is no recourse or no ability to go back to their customers and say, I'm going to update my pricing. So their exposure is absolute for that 12-month period. And if the exchange rates do move, let's say they move 10%, this company, to remain competitive from one year to the next when they put their pricing up, it just wasn't realistic to be able to say that if the exchange rates move 10%, they're going to say to their customers, oh, hi, Bob, I'm going to put your pricing up 10% this year because of foreign exchange rate movements. And they reckon they'd probably be able to get somewhere in the middle, about 5% in the form of price increases. Receivable days, 60 days for their dollar sales. They have a few outflows in dollars. So they transfer funds over to China for a few suppliers on a monthly basis, and similar terms with their supplier. Their supplier updates their pricing once a year, and they have a gentleman's agreement that they'll split the adverse currency movements if such a scenario occurs. And they have 60 days in which to pay for their suppliers' goods, and they sit on their stock on average 35 days. Those questions are important. Payable days, how long you have to pay for your stock, how long it takes your customers to pay you, and how long you sit on your stock. Because if you add all of those days together, that will give you the increased amount of time that you are exposed to foreign exchange. So it is an important metric. Didn't have any loans in dollars, and they weren't sat on any significant cash dollar deposits. So what we're going to start to do is we're going to start to look at their forecasts, their cash flow forecasts, and start to plan and suggest what might be a prudent approach to managing that. The fundamental question of all of them, amongst anything else, and if you go back to my common hedging mistake of the sales director saying these numbers and the financial controller buying currency in accordance with that, you need to know how certain your forecasts are. So a simple example of that would be, if you are buying a piece of machinery, you pay a 15% deposit today, and you need to pay the balance of that contract in 3 months when the machinery is being built. That is an absolute commitment. Both parties are committed to that contract, and so that there's no wiggle room. You need to send the remaining dollars for that contract in 3 months' time. If you compare that to a sales forecast, which you're going to do as accurately as you possibly can based on previous years and based on industry trends, they're a very, very different beast. And so you need to understand how secure or certain your forecasts are. So that's, in a snapshot, what this client's foreign exchange cash flow summary looks like. Ins in the terms of sales, $600,000 out to their suppliers, and they have a net result of about $500,000 on a monthly basis, or $6 million over the course of the year. The company's profitability will have a large bearing factor on their approach to foreign exchange. Average UK profit margins, the last time I checked in the UK, 13%. If you are importing or exporting goods, generally you are below 10%. That's what we tend to find. So if you're back to Simon's slide on the impact foreign exchange rates can have on a company that's profit margins of 10%, why that's important is the tighter your profit margins, the higher impact foreign exchange can potentially have on your profitability. So what we start to do is the system has analysed the data points based on known currency hedging strategies that financial institutions, banks, hedge funds, large PLC companies, sound strategies have been using for numerous years, and has suggested a strategy. I'm not going to spend too much time talking about the ins and the outs of the strategy at this point, because that really comes within the implementation stage. But at this point, this company has $6 million in terms of foreign exchange exposure over the next 12 months. So we can start to stress test, and we can start to illustrate what impact such a movement might have on the company's profitability. So Simon said 10% exchange rate movement, or we've had a 5% exchange rate movement this year, but thus far, but 10% exchange rate movement, if you look at what the majority of the banks and financial forecasters are calling, would not be an unexpected exchange rate movement over the next 12 months. So currently the exchange rate is 138.32. If that exchange rate moves 10%, it now means that to achieve a pound, instead of that pound costing you $1.38, it's now costing you $1.52. Best case scenario, 10% exchange rate movement in the other way, the exchange rate goes down to 124. So based on this company's exposure, if there is a 10% exchange rate movement, this company is leaving just shy of £400,000 on the table with regards to foreign exchange risk. If we look at what's happened with COVID, and say COVID has seen a 15% exchange rate movement, and let's say that that's replicated and pound gains against US dollar, that impact is over £550,000. So if we just flick it back to say 10% for the moment, this is really the important question. And the important question for the business is that a palatable risk? Is that an acceptable tolerance level for you to be conducting yourself with regards to foreign exchange? And only the business can tell you that. And that number is going to be a different number for every single business. But let's say that isn't a palatable risk. The strategy, one of the strategies that we could implement could reduce that risk from 400,000 to a little over £100,000. And it's at this stage that the company should start to think about, I want to buy currency in accordance with such numbers as this. Clearly 400 grand isn't a palatable risk, but 100,000 on a 10% exchange rate movement, that is something that the company can deal with. And what the company then does is says, I therefore, rather than having opinion-based purchases of currency, or buying currency when the market moves dramatically up or down, you can start to say, I want to buy currency in such a way that it's going to limit my risk to £100,000. As I said, we're not going to spend too much time focusing on the strategy, but this gives you a hymn sheet. It gives the financial director, controller, a hymn sheet to say, If you want to limit your risk to £100,000 based on a 10% exchange rate movement, here is how you go to the market and buy currency. How much, by what percentages, and to what months. And so that is that hymn sheet. And I think at that stage, I'd like to hand back to Simon to talk about the next stages of implementation. But I hope that has illustrated the importance of quantifying the risk and then starting to formulate a policy that enables you to buy currency in combination with trying to limit your risk to a pound and pence amount.
Thank you, Gary. So we'll just go back to where we got to. I hope that's given you an insight into how we create our policy, a currency risk audit, and how we get to a place where implementing that policy can very much help to both eliminate the risk and protect you going forward. So if any of what we've shown you today does apply to you or your clients, the next steps would be to book in a currency risk audit. We will take you through those data points or your client's data points and illustrate to you how we implement them into the system. And then from that data and a discussion that's going to be over probably a Zoom at the moment, we will discuss the hedging policy document that gets produced. So we will produce that hedging policy document for you and then take you through that and outline the data points that have been created and the strategy that the system is going to suggest. And then all of this is put together with one of our executive currency strategists. So as I said at the beginning, this is about mixing opinion, your opinion, and our opinion with data. Not just solely your opinion or our opinion, because obviously that could be wrong. We're not here to predict the foreign exchange markets. We're here to protect you against them. So the two go hand in hand. And then together, you work towards implementing that strategy. And that strategy can form part of an executive decision-making protocol. It can be something that you follow as lightly or as detailed as you wish, because business does change, but we can implement that strategy and adapt it as your business changes over a period of time. So how do we actually implement the strategy? And I'm just going to take you through that very quickly. So we review the currency risk audit. We will make changes on certain anomalies. So seasonality, your business seasonality, climatic conditions, obviously, political, what's happening at the moment. We'll formalize how the company will buy the currency in accordance with the strategy. And then the most important thing really is to make a start in implementing the strategy. That's going to be critical here. Whatever we decide together, whatever you decide is in the best interest of your business, like anything, the most important piece is to make that start and start a position so that you have a base with which to grow and develop. And as I said, all of this will be alongside your executive currency strategist. And their role is to support you. Their role is to give you the information that you need and to support your business with the expertise that they garnered. So, how you can take control. If you'd like to find out more, if you'd like to have a currency risk audit on either yours or your clients' businesses, then please email me directly at simon.miles@centralfx.co.uk, and I can arrange a consultation with one of our executive currency strategists where they will take you through the 30 odd data points that we have to create your currency risk audit. And then from there, we will produce your hedging policy document and we will arrange a time to meet with you and discuss it. And then moving forward from there, how to implement it and make a start implementing it. Please send me a connection request on LinkedIn if you haven't done already. And finally, Hinal, I don't know if we've had any questions put in the chat, but please, if we do, please let me know and we will endeavour to answer those.
Hi, Simon.
Hi, Hina.
Hi. Yes, so we have had a few questions come through. I'll just go through one of them. So if I wanted to offer this to my clients, how do I go about introducing them?
Okay, very straightforward. Firstly, what I'd like to say is that we will firstly ascertain what your client requires. There is no hard sell here. The most important thing here is for us is to ascertain if what we can give to the clients is going to be of use to them. We'll do that through a general discussion, a general introduction, and exploratory call alongside the currency risk audit. If what they're doing at the moment suits them, we will very much tell them that. So I always like to get that off at the top, because we're not in the business of hard selling people to change something that's working for them. The idea here is to create a more sustainable environment and create something that will work for them going forward. But the easiest way to do would be to reach out to me via email. We'll have an exploratory call, an introduction call. It's good to get to know all of the people that we're working with, particularly face-to-face, although it's difficult at the moment to go out and visit people. And then from there, make an introduction, and we will reach out via email, arrange a time to speak, give you the right information and arm you with the facts so that you can also download that to your clients, and what the idea here is of how we will work with them. And then from there, we'll set up the call and currency risk audit for the client and take them through the process, culminating with them having a hedging policy or strategy that they can use going forward, and culminating with them with us giving them the indication of how to implement that and how to make a start protecting their foreign exchange requirement. Have we got, I think we've got time for one or two more. One more if there was one in there, Hina.
Yeah, we've got, do you have to use the policy hedging strategy suggested by the system?
No, you don't. Obviously, the parameters to bear in mind here are, as Gary alluded to there, this is about setting a risk parameter that's acceptable to your business. Now, not everyone, wants to completely eliminate the risk for the very reason that they would like to take advantage of the upside. And, the market will move in one of two directions. By eliminating all the risk, we can do that. If it's very important to you to create a budget rate, that's a costed rate, and protect that profit, then obviously the ideal scenario here is to cover all of that risk as far forward as that contract is stipulated. But a lot of clients would like to see the benefit of the upside. So the risk parameter that you're accepting here, as Gary said there, with 5%, 10%, is how we create the policy. And the policy is born out of that risk appetite. So what the system will suggest, a tapered strategy at 65%, rolling monthly for a period of the contract, let's say 12 months. If you want to stick to that, then it's vitally important that you follow the policy to the letter. But you don't have to. You don't have to. It might be that you'd like that as a guideline. And then in conjunction with the conversation you're going to have on a monthly basis, certainly with your executive currency strategist, together you can decide what's in the best interest of the business at that moment in time, because it needs to be agile, because business is agile, particularly at the moment. So the benefit of having both the opinion and the data policy means that you retain agility and you can make the right decisions that bear upon the business at that moment in time. So to answer the question succinctly, no, you don't have to stick to it. But if you would like to stick to the risk parameter that you've set, it's in our opinion that it's probably the best thing to do. We've got time for one more here now, if we wanted to take that.
Yeah. What does a relationship look like with Central FX? How does it work in practice?
So from the moment your inception of your relationship with Central FX, from the moment you introduce us to yourselves or to your client, we will bring your executive currency strategist into that loop. And it will be their job to create your policy. So you'll get to know them immediately. The relationship here is key. The more that the executive currency strategist understands your business, the more that they will be able to help you. And then on an ongoing basis, you agree the timeframes with which you would like to meet and what's best for your business. We certainly don't want to be calling you every other day because the market's moved 0.5%, or Boris has said something yet again that's caused controversy with the foreign exchange markets, or Brexit trade deals loom again. So it's for you to decide with your currency strategist, what's the most important information? What changes the direction of your business? What's fundamental to helping you manage that risk? And we put that down and agree a time frame with which to talk. Of course, if anything key does occur, it's these currency strategists' role to let you know. You have a direct line into them at any time, and they're incredibly reactive as well as proactive. And over a period of time, that relationship is formed. And obviously the most important factor here is the word trust. We need all of our clients trust us implicitly to guide them, to enable them to make the right decisions. We're not here to tell you what to do. We're here to guide you alongside a policy document that does tell you what to do if you want to stick to that risk parameter, so that at the end of the year, you have a stable environment. This is not about speculation. And I think that's what's key here. There is such uncertainty and volatility at the moment. It's very easy to get into the world of speculation. You know, you haven't created a business that's sustainable, that pays people's wages and looks after people's livelihoods, to manage it with speculation. This is about managing with certainty and eliminating that risk. So it's the currency strategist's job to help you do that, provide you the right information at the right time around a concerted hedging policy that allows you to make those decisions in the best interest of your business. Okay, well, look, thank you very much for all attending. It's been a pleasure to talk to you all today. As I say, if you have any further questions, if you'd like to find out more, if some of the stuff that we told you made sense or perhaps didn't make sense at that moment in time, please just reach out to me and ask me the question. Drop me a LinkedIn connection request and we can talk on LinkedIn. And it would be a pleasure to assist you or your clients with any matters arising to foreign exchange risk. So with that, we will bid you farewell. Be safe and enjoy your days. Thank you very much.